People are busy on report day. Okay, now it's 4 o'clock. We haven't recorded a single thing.
I'm ready to roll.
I'm not. What are we talking about?
2025 hedge ideas, and we're going to go through some specific stuff.
Okay.
And then the report today we'll briefly touch on. Big surprise in the corn today. We could start like all the other podcasts. I don't think
it was a surprise.
But. Oh yeah, that number absolutely a historic, shocking number.
I was expecting 1.8. What was it? I was at the gym.
1.73.
Okay. It's a little lower than 1.8.
If there's no yield or anything in this is just purely demand-based numbers, which that's why it's normally a snoozer, because from November to December, things don't change that much.
Right.
So to lop off 200 million bushels in a December report, you're not going to see that very often.
And the market didn't care.
It did care, but at the same time, 1.7 is not $5 corn either.
Sure. All right. Well, we should probably save that for the podcast now that we know what we're talking about.
Yes. Oh, yeah. No, this is going to be a good episode. A wonderful episode.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, an absolute snoozer. Or wait, an absolute shocker of a report? What's the story here?
Everyone was geared up for a snoozer, but we had some news in the markets. And it's not, and we were talking about this before the podcast, not so much the number and that equaling a much higher price. It's why did that number come out today? So that was the big surprise. From November to December, the USDA, in all its infinite wisdom, has decided to cut near 200 million bushels off the ending stocks. What would you say, about 1.5 off the lowest guy? And why is it unusual? You just don't see those kinds of cuts in December. And that's why I wouldn't call this a special report, but you have to wonder why the USDA is in a quick hurry to put the entire extra demand that we've been seeing from Mexico in this one report. Why are they in a big hurry to do this? That's why I think if you read between the lines, 1.73, what do you think that equals in a corn price historically this time of year? I'd say 170 on the high end. I mean, what's your guess?
Not a clue. That's not my department.
And it does have to do with the attitude of the market. So why I think this number was important today is just because why would the USDA say it? Why are they in a hurry to lose all these bushels? What would be normal for the USDA is to kind of slow play it, 50 million bushels there, 75 maybe on a big day, and then ultimately get up to this 200 number over 4 or 5 reports. Why do they feel compelled to get way ahead of what it looks like they need to get ahead of? If I had to guess, I would say there's probably better news coming in January, and they couldn't put it all in the January report. Theoretically, they're not supposed to know what the January numbers were, but they might have a better idea this year because of how fast the harvest was. But I think in this episode today, I think it'd be a wonderful time to talk about, now with this report out of the way, what should a guy actually be looking at specifically for hedging ideas for the 2025 corn and soybean market, more on the corn side of things than anything. And then I think maybe touch on cattle. But this report did change things today for sure. And it should provide better hedging opportunities. At least that's what I'm seeing.
I don't 100% agree with you on the. I mean, I wasn't shocked the number was big. I more watched the tape. I expected more reaction from that big of a change on the number, but it sure seemed muted. Now, some of that probably relates to volatility, which is still low.
And a lot of it to the soybean number.
Super boring.
The number for soybeans is terrible.
Right.
And so it's a unique market where, like you say, it didn't have the reaction because now you have a huge anchor on a market that has a bigger question mark than it had. It didn't mean that it turned it into a mega bull overnight. But how do you trade with wheat and beans not following? And that's what the market That's exactly the kind of market that you would see a little creep up the whole day. And that's what corn did. Yeah, 6-7 cents, but it's also on top of what has it been up 9 cents over the last couple of trading sessions. So it's built on a further rally. And again, why I think it's an important number is because you just don't see this in December. This is not a normal thing that the USDA would put out. So you would imply that the USDA is just handing them a Christmas gift and just being friendly, which I don't think that the USDA does things to be nice. Obviously they try to put out the correct numbers, but this looks a lot like where they're trying to adjust numbers very fast for some unknown reason. And that's what got my attention is why would they do this? Like it's very unusual that this number would come out like that.
Well, I know we've talked a number of times on here that, well, you don't necessarily love the USDA numbers. You have to go off the USDA numbers.
Yeah.
So
yep.
I think does matter.
It does. So 1.73 is infinitely better than 2 billion bushels, just for a lot of different reasons. One being that 200, 300 million bushels that we're talking about is the difference between having a buffer going into next year and not having a buffer. So that's why it's also very important in that regard. So now we have another yield adjustment coming in January. So if they take off a bushel, keep demand the same, then all of a sudden it's 1.6. And, so you lost that buffer that they have to play with. Why would they just throw that out the window at a time in the year where they normally wouldn't, nor would they need to do that? If you need to get more data, more numbers, why come out with this number today? So it didn't make a lot of sense they would, other than they have more adjustments coming. We don't know that, but here's why I'm excited. It's going to provide an opportunity, or at least a lot better opportunity than it looked like we had 2 days ago. So how does a market play out that has a very bearish B number? Corn or wheat, what would you say other than wheat? Neutral, slightly bit friendly?
Maybe, except the exports have been way under also. So the report was maybe a little friendly, but
yeah, and the report's out of the way. So it's the opportunity that it provides. That's why I'm excited for this number, because it gives a guy a time to think about what he might want to do. If he's doing incremental corn sales on the way up here, it also is a lot more friendly market for that. So you don't have to make all your decisions in a very short period of time. But like you say, it's not going to change the market to where we're going to run out of corn. Not only that, with this kind of number today, you can expect more corn acres next year because it's just a healthier looking number. And guys are going to see this, read about the report, and say, hey, I'm making some planting decisions right now, so maybe corn makes more sense after this report. In a year where nothing needs more acreage, corn looks like it's going to be, what would you say, 94 million acres is a good guess today. Of course, that's going to change a lot, but I'm excited for the opportunity that it's going to provide, because what we're at 429 December 25 corn and 430 for March, and things weren't looking very good. So at least we have something to work with, I guess, is why I'm excited.
I just think, we've had the slowest rally ever since September. And we've been gradually moving up maybe since early September. Yeah. But to hit 450 today, I think was the high that we hit. I just see that bringing some selling in, some sellers who've maybe been sitting on stuff that may not
storing
be
it in
good
the
for
spring.
the price.
Yeah, storing it in the spring hasn't worked. And I do think that the bushels are a little looser than they've been. And I have heard that number a number of times thrown out there, that 450 would be a number they'd be willing to sellers. And then you talk to guys, and it sounds like corn's moving in commercial spots. It sounds like that this market, a 3-day rally, like you say, in this kind of market, it's been terrible. Seems like a very good deal to offload some bushels. And I definitely talked to guys that have done that. And you know what? That's what you should be doing this time of year. It's a time of year where it moves up. You can't keep 100% and just, some guys do. You just want to make incremental sales anyway, and that's exactly what's happening. So you got a nice balanced market more than anything. It's just better than the dread that hangs over an extremely bearish market every day.
Well, and that leads us to the main topic for today, and that is hedging opportunities, which That's the best part of rallies in December, right?
Yeah. Yep.
There's opportunity again.
This was falling from a higher price last year, but we still had profitable prices to hedge at. So it's not real fun to talk about hedging when it's all losses. It's like, well, that kind of defeats the purpose. Hedging and losses is not high on anybody's list to do. This changes the opportunities that we might see. So if it starts creeping higher, then you have a lot more directions that you can go. You can sell physical bushels. You can look at what 2025, where those puts and calls are going to be, and then and start planning for that, because that's what's going to be important. You're going to have this window, such a unique market. You just don't see this very often, where you have about 3 months of good news for corn now, it looks like. But on the tail end of it, there's going to be so many acres, it's going to turn very bearish again. But we don't have any buffer to have weather problems, and you can't assume at the beginning of the season that it's going to be perfect. So expect more volatility, meaning without the buffer now that they got rid of today, you're able to rally on a little bit of news, dry Argentina, or any of that news that comes. It's a market that's just in a lot better position than 1.9 and good weather in South America. Whether it's just something to talk about, yeah, I would agree with you that you're not going to run out of corn, and no one thinks that you are. But at least now 25 might come up to a level. And here's what I want to do. This is a specific. It's not a recommendation. I want to look for levels where I can buy a put, be it in the money or near the money, to where I can get like a 460, 450 floor, and then have my upside wide open for the rest of the summer. So I would be looking for this limited risk, and it probably will cost 30, 40, 50 cents, but you're going to lock in a nice high floor, futures, and then you have the upside wide open. Then you won't have to worry about the politics, and you won't have to worry about what the weather is going to be for the U.S. You just know what you can lose. You know what your upside is, which is unlimited because it's going to be open. And you know what you're spending on, or you know what your floor is. So last year specifically, what was available was $5 puts. And why did I buy an in the money put last year? Because it was a market that seemed like it was going to go lower. So when you buy an in the money put, you're trying to get away from paying all that premium. So at the time when I started tracking, I think it was 45, maybe even 50 cents. A little too rich for my blood, but eventually they got to be down to 34 cents. So if you do the math, we'll use 35 cents for easy math. You could effectively lock in a 465. I had to do math on the fly there. Floor.
That was impressive.
Well, I had said it so many times, I just remember. No, you got a 465 floor, and that's the worst that you can do, no matter what the weather is, on futures. But then you had your upside wide open. And the reason why I bought an in-the-money put last year, or suggested it, would be that I didn't want to pay, let's just say you looked at the time it was $4.70 for 30 cents. Yes, that put was cheaper, but then your floor is down there at $4.40. Some more math. And instead of a 465 floor, you had a 440. So why did I choose in the money versus the one at the money? To get away from all that premium. So when you bought it at the time, it was in the money, 25 cents. You pay another, it would have been 9 cents at the time. So you're only paying 9 cents versus 30 cents a premium last year. And I know maybe it got a little complicated there, but you would buy an in the money put to try to get that premium down, even though it's more money out of pocket. It was in the money, which is intrinsic value, and away from all that pure premium. So that's what I'm going to be looking for this year. I don't know that opportunity is going to come, and the numbers have to work. It might not be $5 and $4.65. It might be $4.80 and $4.40. It just depends on what the market gives you. There might not be any opportunity at all. It might show up in a very short period of time, or it might be like last year where the market really didn't even go up. Just time went on, and that got cheaper. The volatility went down, and they just simply got cheaper in a market that was slowly declining. So when I put the hedges on, or suggested to put hedges on for guys last year, it was in a declining market. It wasn't even going higher. So we don't know what this year brings, and I don't have an official recommendation. That's not what I'm doing here. But what I want to do is because that buffer now is gone from the corn that that was in the report today. Of course, the numbers can change in January. I'd like to keep the upside open, and you make fun of me all the time. That is a position that I do like. I like to get that floor bought, and I like the upside open into the growing season, and then mid-growing season. I have very different things that I look at, but that's where we're at on corn. So a specific hedge would be exactly what I said there. I ultimately want limited risk with upside open. Try not to pay too much out of pocket, but with all those looming acres next year for corn, that might be hard, and I might not even get a chance. But at least with this report, I'm a little more optimistic that we'll have some opportunity at something, and it might be very different than what I just talked about. But just offhand, that's what worked last year, and it was a very good hedge, very effective hedge. You still had to get out in August, and as you know, the low was in August. If he stuck around that hedge until December, you wouldn't have done as good as you would have done in August or September. But truthfully, the market topped last year when it normally tops. For the summer, I'm talking for the summer before the descent, and then it bottomed where it normally would have bottomed.
Makes sense. I do think one advantage you have right now is volatility is still low, so that's helping those put prices.
Yeah.
Question for you though is when you're looking at these or looking at times you would recommend buying these puts, do you kind of have a target price, like looking at these numbers today, looking at the weather possibilities? I think corn can get to X, and that's where I'm going to start looking. Or when do you start top picking? What's your goal? Or do you start incrementally? Now we had an okay rally from the report today. Numbers look good. We would expect the price to go up. Not that we know where the market's going.
It could follow through on those numbers, yes.
So we wouldn't want to hedge the whole thing on today because we got one little rally. But where do you start picking that number? I mean, you threw out 460, 480. I don't think anyone's calling for $5 corn right now based on these numbers. And that's important to know too, right?
Yeah, and we kind of were trying to figure out that number. You'd have to go look back. It has to do with the attitude of the market, and the attitude is pretty good. The funds actually have been buying. Like if this is a market like last year where you actually had decent news for corn, it wasn't terrible, but the funds were in a sell mode. You have to first recognize what kind of market that you're in. And there's a little tailwind here, and the funds do like it. Secondly, you want to look at the seasonals. Like you look at seasonals, and you generally will see a rally in December for corn. So that makes sense as well. And then you want to look at just historically where you are in relationship to the fundamentals, which we talked about earlier. And, set realistic price targets off that. And that's all you can really do. What I like about this is now we're talking about profitable numbers, where a number of days ago we weren't there. And that's the whole point of hedging. So there gets to be windows that it's much more important than other windows. What you often see in corn is almost a double market, meaning like you have some bidding for acres, you slowly rise into spring, then all of a sudden the planters roll and you sell off. Then along comes a summer rally. So you usually get two chances is the truth. Not always. Last year it didn't really provide two chances. The year before it certainly did. So there's two different time frames going into spring, looking for that price that makes sense. I think January is where it happened last year. So I'd be looking at similar time frames this year, January into February. And the one big dark cloud that still remains is South American production and weather. Although Argentina's drying down, you have a large production, and that's why you can't just have this cookie cutter deal. You asked, what would factor in? That would be a big one for me this year, to hurry up. If that weather continues to be good, I think that's going to pressure soybeans, and you would have to make these decisions sooner rather than later. So for me right now, looking out about 6 weeks makes sense, and hopefully everything holds together. Lots can change though, as we talk about, and attitudes can shift very abruptly. You could have a Trump tweet of some sort that could change the outlook very quickly. So expect volatility. I mean, that's what we're going to head into right now.
Yeah. I mean, just like everyone talks about when funds are short, that it can easily just be the fire for a rally. When funds get long,
Yeah.
they can change their mind at any moment as
Yeah.
well. So being aware of that.
Yeah, your ideal hedge would be the funds long 350,000 corn going into mid-June, and a lot of rain in the forecast with a very high price. You'll get that sometimes, but it doesn't always line up for you like that. But that ideally those are the windows that you're looking for where it makes a lot of sense to make a hedge. We've been in no man's land. We've talked about other topics. We haven't really even had a chance to talk about hedgeable prices except for cattle. Cattle's grinding higher, and that brings me to our saying of the week.
Ooh, all right.
Never sell a creeper, and that applied to even corn yesterday. That I do like that. That's one of my favorite sayings. I did text that to you last night, so I wouldn't forget it for today. They say never sell a creeper. Cattle's had a little volatility, but that market that just kind of creeps up on you every day. And corn had been doing that, creeping a little too slow. Actually, almost lulled everybody to sleep.
I was asleep.
But that is a saying because it's usually a market that's got enough to keep it going, and then the story can build on that. And they're just dangerous markets to sell. And I do like that saying because that's one of them that tends to work out more than often than not. So we've had a little creeper in corn, and cattle's been definitely a creeper. There hasn't been gigantic days in cattle. I had a few like a month ago, a few good days, but it's just that grind higher, good healthy bull market or the beginning of a bull market. I would say that about corn, the beginning of a bull market. But I would say the beginning of better opportunities. But never sell a creeper. You can put that one in your file cabinet or on your little trading computer.
I'm writing a sticky note right now just so I can remember that one.
I wonder if I can come. I mean, we do one of these. We should be able to come up with 52, no problem, or at least between the two of us. I think we're only on week 4 on the one saying per week.
I think we might need a wager on that.
And we might repeat some. The odds that we get called out on repeating them aren't very high either.
Good point.
So we'll probably end up repeating. I think if we can get to 52, we're going to try hard anyways.
Yeah. Well, I think if we do 12 of them.
Back to the hedging side.
The same one 4 times.
On the hedging side of stuff, though, these are markets that I would move to a very limited risk and be ready to shift your attitude fairly quickly, because we're going to head into a lot of politics shortly. What's the date of the inauguration?
I was going to look that up, and
I've
I'm going
heard
to go with
January
January
20th.
20th.
Yeah, I've heard that a couple times. So we're going to head into a lot of volatility and not a lot of answers. So I think it's going to be an exciting market. I mean, I don't think that we're going to be bored from here on out. At least we have stuff to talk about now.
Well, and I would say, like you mentioned at the beginning, at least for corn, there's opportunities coming up. Tell me about soybeans, though. That was not as good of a report.
No, 470 is not a good number. I mean, I think where were we last year? 220?
Yeah.
Okay, so what would be considered going into a year is anything below 190 historically. Last year, I think it was 220. Back in October last year, they were expecting us to run out of meal by spring, and it's going to get among the tightest that we've seen. It didn't work out that way at all, and that was with 220. We have a lot better weather this year in South America, and we have 470. So that to put it in perspective, it's not a good spot. That's not a number that you want to see. Things do change very rapidly for soybeans. There was 6-7 years ago, it started raining in April on what looked to be a very large soybean crop. I think it was $9 at the time. Nobody gave soybeans a chance to go up, and it did go up to $12 briefly in a month. And that was because they couldn't get it out of the field. China panicked. They were worried about, all of a sudden what looked to be very cheap beans, like, are we even going to have near the supply out of South America that we thought we were going to have? Exceedingly rare that would happen. It is the rainforest, and it did happen that year. So you can't ever fully rule beans out. And what happens if Trump gets in there and the trade deals go wonderful? What happens if, or there is no tension and he gets busy with other stuff and they don't even talk about China, At the same time, we have some weather problems in South America. So you can't really rule beans out this time of year. It's a mistake to do that. But I mean, it wasn't a good number. That 470 didn't change, but that's not what you want to see. If you look at a historical chart, 2019, the trade war, it was worse. But beyond that, I mean, it's among as bad as you're going to see this time of year.
So what do I do if I have beans?
I was asked that a couple times today. Hope that corn can pull that beans up for better marketing, and that's saying something. When you're hitching your wagon to the corn train to do the heavy lifting in soybeans, that's asking a lot. But that's what we're looking at right now. That's what happened today. I don't think beans would have went up by itself on that number. The good news for beans is we have seen phenomenal demand. There was rumors of Chinese cancellations looming. So you're going to have to navigate that here pretty soon. They will let the games begin. I mean,
Right.
China likes this time of year, and it's not like they cancel and walk away. They cancel and the contract's replaced, and they have to pay the net difference between the two. You don't just walk away. There's a lot, but the thing is, it doesn't help the market when it hears this. So we're about a month away from that actually being realistic, where they would start canceling some of the U.S. purchases. But we have seen phenomenal bean demand. We're right on pace with where we need to be for the numbers. It's just the numbers stink. 470 is not a good number, but at least we don't have poor demand like we had last year in soybeans, or not very good demand. This year we have much better demand. And if we can clean out those commercial channels with corn, I mean, you can mount a rally of some sort.
Well, on that note, let's go to some fun news. Let's talk about the meats, because holy cow. I
Yeah.
was looking at June hogs.
Yeah, the funds are
102 or something. Holy cow.
they added to their substantial long position, and you look at the numbers, and the numbers look friendly. The cash market's good, products look good, and everything's good with hogs. And you don't often say that. That's just not a phrase that you hear. The hogs look great and healthy, and everything looks good in the hog complex. But that's where we're at. Things can change very quick there. But it's mainly the industry's not been making money. Why would anybody have expanded? It fell extra early for everybody. They didn't even give them the hope that we're going to have high summer prices. They just smashed it in the face right in springtime, and it never really looked back. So it's not surprising that it's starting to show up in the hog complex at all. That maybe when you're severely unprofitable, that you wouldn't expand. So between a little bit of disease and just non-profitability of the industry, you're seeing tighter hog numbers in December. That's very constructive. You hate to get too bowled up in hogs because they have a way of letting people down. And I don't like the fun position if they're stacked and they're long in hogs. That's about as dangerous as it gets too if you're long. But for right now, they got a tailwind. I think the numbers just this year versus last year look a lot better and a lot healthier. So if they get tighter, we could easily go higher, but you got to watch that fund position. You might want to, get something underneath it hedge-wise. Puts if it looks like the numbers are going to change. But we are going up in a time of year normally we wouldn't. Cattle, again, a very, very good market there. You listen to the guys in the sale barn. Everybody's paying anything. I learned from a very good trader / broker a long time ago. He said, never underestimate a rancher with a checkbook. And it's never been truer than what's going on in the sale barns right now. They're willing to pay anything for anything. You just hear a news story every day on what somebody paid and they can't believe it. Then the guys that passed on those prices, they look like they shouldn't have 2 weeks from then. 2 weeks earlier, if they would have just bought it with their buddies, they would be making the money their buddies are making theoretically on these cattle they just bought. Right. So I would call it a game of musical chairs. I mean, a lot of others would disagree, but it's all fun until the music stops. And it does look like in an area where you definitely should be talking about hedging. There's a lot of hedges that make sense. Feeders are a little more expensive. What's unusual about the cattle market, I think we talked about this, is the curve had flattened out so much. They've widened some of these out, and there's a little more in between these contracts. But all the curve got very flat. The market looks good though. I mean, we got good, solid seasonals through basically the beginning of February. But the cattle market and the hog market are markets that have a tendency to get the legs kicked out from under them for a lot of different reasons that you can't foresee. Not much on the screwworm, but in good healthy markets, you don't have, if you're cheering for cattle prices to go higher, you haven't been very disappointed over the last couple months at all.
I would definitely agree with that. I think somebody needs to get the buy now, pay later into the cattle barns.
Yeah, we should actually set up some sort of credit
payments,
credit plan there. That seems like a good idea. I don't know how that could go wrong.
Right.
It's almost as good an idea as getting into the cattle business right now.
Right.
Yeah, no, I have a couple buddies that they couldn't lay off the high fastball. They're kind of part-time cattle guys. So they bought a few animals here. So a lot of feed laying around, a lot of bidding in the sale barns. We'll see how the winter goes. I mean, if they take a bunch of weight off these cattle, it actually could get very supportive. But so far, the winter's been pretty mild. It's been a normal winter. I don't think there's anything bad in the forecast. Have you seen anything?
I haven't seen anything except, well, actually, what I have seen looks really nice for having cattle. I think it's supposed to be back in the mid-30s around here, but that's just my backyard. So
Yeah.
I don't know what's going on across the country.
Yep. It doesn't look like there's blizzards yet where these cattle are going to be losing a lot of weight. So at least we have that. And just overall, a very healthy looking market. But again, I don't take that with a grain of salt. I don't trust cattle and I don't trust hogs. Futures specifically, not so much the cash market. I think the cash follows futures, but it has a way of looking great, having you feeling great, and then all of a sudden not be so great.
Well, and after today, you might want to stock up on your feed because cheap feeds looks like it might disappear.
Didn't seem to bother feeders one bit today. It was already in a good mood, and again, it was kind of a sneaky report. It wasn't so much that it was going to send corn limit up today, and no one thought it was. It was, why did they cut 200 million bushels off in December when they didn't, with everything we needed that we know, they didn't need to do that. So why did they do that? And the guy in the feeder barn's he's not gonna be thinking that today. He probably didn't even see the corn market, so it wouldn't have bothered him today. But yeah, that sheet feed and the piles and everything was going to be free. And where are we going to put that? I think those days are gone for sure.
Makes sense. Anything else to add today, John? You want to talk the gold market? Gold market's been interesting.
Yeah, let's talk platinum. I like platinum.
All right.
Yeah, it's got very good seasonals, and a lot of this has to do with the jewelry and Christmas gifts. Ooh. So you do see a seasonal here in the metals. A lot of guys have been talking about the gold miners, how they've been underperforming versus the gold. Then gold and silver and everything cooled off. No, you have a pretty good economy right now. So as far as the numbers look, so you should see, especially if interest rates are going to come off, you should see metals have a good bid under them. But talk about a market that can get the legs kicked out from under them. They correlate very high to what the stock market does. So if the stock market has a big dip in it, metals generally will follow, and it gets to be a very economy, orientated trade. But we do have a seasonal up for platinum. I know that. If you want more information on that, that's something I like to follow. I don't know why I like platinum. I think because it's a 50-ounce contract. And it used to be more expensive than gold, and it's not anymore. And it's a little more forgiving of a metal, if there is such a thing in commodities. It's a little more forgiving, but they do have some nice sized contracts. You have 1,000 ounces silver contract. You have a 33-ounce gold contract. You also have a 100-ounce. You have a 5,000 ounce silver contract, and then the platinum obviously is the 50-ounce. So you have a wide variety of sizes. Most of the buying, though, that I find is in the physical markets. And I haven't really talked to any of the dealers that I talk to sometimes. I don't have a feel for how good the demand is. I know you go back about a year and a half ago, you were paying, $3, $4, $5 premium over the spot silver price. All that's cooled off, and we're back in line with reality, $1.75, I think. But metal markets are exciting. I do like platinum. So if you want to talk more about that, give me a call.
Sounds good. And how do they reach you?
218-731-1578.
Thanks, John.
Yep.
What did you text me last night?
That's why I text it, because I forget so fast.
All right.
I'm like Vegas Matt.